Somebody you should be following if you're in the real estate business or mortgage area, or frankly will ever be borrowing money ever, which is most of us, is a gentleman by the name of Jeff Gunlock. He is often referred to as the bond king. He is out on CNBC, Bloomberg, MSNBC, and all these other media outlets, basically saying the Fed is lying or the Fed is wrong. He lets you pick, and you need to be watching the bond market for where rates are going. What he is basically saying is the bond market is right, the Fed is wrong. The Fed's taken us to 5-6%. Nope, we are going lower. Anna, I know you haven't seen this article, but it's worth a conversation. Do you think the Fed is lying and or wrong? Do you think the bond market is telling us? Because this yield curve inversion is record setting, both in size and now duration. It's something to watch. Somebody's right, somebody's wrong. What do you think?
Yeah, it's really complicated. It really is. And I do follow the bond markets. I'm not invested in any bonds other than I bonds through the US Treasury. So, I'm not a bond expert. So if I say something wrong, don't shoot me. But here's what I know at a high level. Having been in private banking, I was previously licensed. So I have a rudimentary understanding of bonds. What I do study is the yield curve. And so I know
Yes.
that the yield curve is very accurate in its predictions when it inverts. It's the 2-year and the 10-year treasury. When that inverts, it's a really strong indicator that a recession is coming. And what the curve shows us, and what treasury rates first and foremost show us, and then bonds, I would say next, is the trajectory of where most investors, most institutional investors believe that we're headed. Is short-term pain worse than long-term pain? Is short-term growth better than long-term growth? And so by watching where is the 2-year treasury and where is the 10-year treasury, we can get a feeling for the feeling of the market and where they think we are headed short-term and long-term. So it really is a gauge of sentiment of what they think the Fed is going to do. So is it an accurate leading indicator? Generally so, when it's recessionary. When it's not recessionary, though, it's not necessarily accurate, right? Because if it was, if bond markets could determine where things were going, they would have exited equities and gone all in bonds. And there is some of that happening, but not completely, because there's still so much uncertainty. So I don't know that I agree that watch the bond market and you'll know for sure where things are going. I think they're guessing just like we are, but trying to take educated guesses. I think that the question about, is the Fed lying? Are they over tightening? I tend to think they are over tightening. And I say that because I watch basically the 10 factors, which we've talked about on this show, that indicate the health of an economy. Is it heading toward expansion or is it contracting? And in all areas of the economy, with the exception of wages and employment, we are in recessionary contracting territory. Labor, non-farm payroll, when we look at production, manufacturing, all of those types of things, we are heading toward recession. And so that tells us that the Fed might be over tightening. And if that's what he's saying, I tend to agree with that.
Mhm.
Inflation is coming down pretty well. The target of inflation right now for the Fed is wages. They want to bring down wages and they want to bring down employment. And when they do that, they can be confident that what we talked about last week, the CPI for services, the wages will come down. People will quit spending so much in services, they can kill inflation. Until then, though, the Fed thinks that they're right to continue hiking. I think they're going to continue hiking until they see strong evidence that wages come down and unemployment goes up. So I don't agree with him that the Fed is going to stop, that they're lying, and that they're going to pivot quickly. I think I disagree with that, Michael.
Yeah, so I just pulled up on my phone current rates just so we can talk about this yield curve inversion and uh, the size. So most people talk about the 2 and 10s, so we'll talk about that first. The 2-year note, at least as of this minute, is 4.2. Let's call it 25. Let's round to the nearest number. The 10-year is 3.57. So that's a 68 basis points. I actually think it's more telling is the 3-month 10-year, which is something Powell has talked about.
Right.
I don't know that I've ever seen it this bad. So again, the 10-year is 3.57. The 3-month, 4.68. It is 111 basis points inverted. I do not recall over 100 basis point move. So I think with the bond markets, Jeff Gunn, basically what I think he is saying is a recession is closer than the Fed realizes. I think that's what he's saying.
Yes. Yes.
I think he's also saying the Fed's going to cut this year. I think those are two things that Jeff is saying. So if we flip over to what the Fed is saying, the Fed has been very remarkably clear, clearer than I ever remember them. We are going higher and we are going to stay there longer.
Yes.
So I do not think they're lying. I think they're crystal clear. The question is, are they wrong? That is an argument. Because again, when these Fed presidents are no better at guessing their future opinions. And I will just remind you what they said at the end of 2022. They thought Fed funds rate at the end of 2022, at the beginning of the year, would be roughly 1.5%. It ended the year over 4%. So
Right.
to think that they are great prognosticators is an exaggeration above exaggeration. But I think they're clear on their plan. I just don't know if they're right. I think in that, and I think there's an argument that Jeff has that the bond market is screaming, "You're wrong, you're wrong, you're wrong." So it's
Right.
an
And I
interesting
agree
debate.
with them. I agree with them there. I think that they are probably over tightening. But here's the thing, and that's because of what we talked about last week. For those of you listeners that didn't hear our show last week, go back and listen to the 4 types of inflation and where they are. 3 types of inflation are coming down. It's really the wages and unemployment that are still up. So that's what they're targeting. And because the job market is so strong, they feel like they have to target it really hard in order to get the job market to come down and wages to come down. That is their primary target, because it's the biggest piece of inflation that we're experiencing is wage inflation. And they're trying to get us out of this economic theory called wage price spiral. Once your wages go really high, you're spending more money, there's more demand, prices go up, and then you have an inflationary spiral. And it's easier for the Fed to get us out of a recession with their tools than it is to pull us out of inflation. And so the Fed wants to give the benefit of the doubt that if we pivot and inflation goes back higher, it's going to be harder to fix the second time. And then we're really going to have to go all in. So I think they don't want to lose credibility. I don't think they're lying. I think they believe that wages is the problem and they have to bring it down. If they might be lying to try to get the market not to rally, because when the
Yes.
market rallies, everybody thinks things are good again. And they don't want that. They want us to feel the tightening so that we quit spending and we're a little bit scared, and so that we save instead of investing. So I don't think they're lying. I do think that they are potentially wrong. I think that they may do more harm than good, and that
Mhm.
may push us into a harder landing than what we could have if they were to pause. But I cannot see them pivoting unless they break the derivatives market and the credit market, and the currency markets. If they break that, then they will pivot quickly and they'll say, okay, this is now a bigger problem than what's remaining of CPI with wages. But unless they break something, I think they're going to do what they say they're going to do. I think they're going to raise rates in February and March, and then I think they're going to pause and hold rates probably through the entire year, because Powell said that the dot plots that they have, that inflation doesn't come back to 2% until the end of 2024 or 2025.
Yeah.
I would bet money, although I wouldn't bet a lot because none of us are always right in these complex environments, but I would bet money
Yeah.
that they pause and they don't lower rates until 2024.
Yeah, that's exactly where I'm at. And I'm on record many times. I think we get a quarter point, what is it, February 1st, a quarter point March 14th, and then the Fed is boring for the rest of the year. There's no cuts coming. And that's because inflation will be coming down, but it won't be 2%, right? We've talked about the easy part of inflation, the hard part, and then the really, really hard part, which was really our conversation last week. People can check out. So great conversation on where can people find you?
Great. You can find me every week here on my playlist on your channel, social media at Anna Kelly, REI Mom. And if you are an accredited investor looking for passive multifamily investments, you can find my offerings at greaterpurposecapital.com.
Thank you so much.